2023, the year the real estate market is going to crash. Or is it? Well, if you read all the headlines, you probably think this is the case, but being a full-time real estate professional in the city of Chicago, we're actually going to take a look under the hood. So I have my good buddy, one of the top lenders in the whole entire country, Justin Lapotton with Guaranteed Rate, on the show today so that we can dispel some of the myths and some of the headlines that you're seeing out there, so that we can talk to you about what we're actually seeing, how we're boots on the ground every single day in this real estate market for 10 plus years, so that you can understand what the real estate market is like and how this impacts you as a buyer or a seller in today's real estate market. All right, so I'm gonna bring in my go-to lender, Justin, here so that he can hit us with some of his wisdom. Justin, what's going on, man?
A little bit of this, a little bit of that. You know, it's just volatile times in the economy and a lot of fear-inducing headlines. Absolutely, you nailed it, man.
Awesome, man. Well, thanks for taking some time to hop on here. As I mentioned, guys, Justin and I have been working together the last 7 or 8 years. Justin is one of the top lenders in the country. So if anybody knows what's going on with interest rates and what's going on or what some of the predictions or expectations for 2023 in the real estate market is, Justin is going to be the guy. So we're going to pick his brain today about what he's seen specifically with interest rates in the mortgage market, so that you guys can understand how to apply this to your current situation. Welcome back to another video. If this is your first time here, welcome. My name is Jordan Pyle. I'm your go-to Chicago real estate agent. And if this info today has been valuable to you, please do us a favor and like, comment, and subscribe. It means a lot to us. And make sure that you turn on the notification bell so that you catch all of our future videos. So let's dive into today's video with my good buddy, Justin Lapotton. All right, Justin, so 2023 is officially here. And there are a lot of speculations going on about what's happening in the real estate market. So you might see some headlines such as this one: is the housing market going to collapse in 2023? So I want to deep dive into this and talk about what you're seeing, being somebody, I think you've been in the market and in the business for 15 plus years. You've done over hundreds of millions in loan volume over the years. And I think that you probably have a good sense of what's happening. So talk to me a little bit about, what's happening with interest rates and what do you think is going to happen with the real estate market in 2023?
Yeah, absolutely. So thanks for having me. I think there's a lot of misinformation. Remember, media is there to get clicks. Headlines get viewers buy products. And so headlines are really meant to drive advertisement, right? So all the headlines are clickbait. And what's interesting is that, a large percentage of potential home buyers are millennials, right? And millennials are they're hitting their peak family stage of early 30s. And why that's interesting is because in 2008, when we had a housing crash, millennials were 14 years younger, right? 17, 18. The housing crash caused the recession. Okay. In 2008, the housing collapse caused the recession. But historically, recessions are tied to just economic ebb and flow of our gross domestic product, right? Is our economy growing or shrinking? And I say all that to say the Fed had to increase interest rates to fight inflation. And when the Fed increases interest rates, the backlash, the aftermath is typically a recession. So follow me here. Fed's fighting inflation because they printed and gave everyone too much money during the pandemic, right? The housing market obviously boomed because interest rates were so low. Now there's all this money floating around and it's raising the prices of everything. So the Fed needs to lower inflation. How do they do that? They squeeze money out of the economy. They make everything more expensive. They increase interest rates. History doesn't always repeat itself, but it rhymes, okay? In the last 40 years, every single time the Fed has raised interest rates to fight inflation, we've seen a recession. Because when people stop spending money, the economy slows down. Big companies lay people off. Look at Amazon. Look at Facebook. Look at, I think it was Goldman Sachs. Thousands of people making 6 figures just got laid off. What does that tell you? Things are more expensive. Consumer behaviors are changing. And so big companies are now having to downsize, right? So we definitely anticipate a recession, but the average consumer, and that's everyone, thinks that the recession automatically means a housing crisis, right? So is the housing market going to collapse? Now let's really unpack that. I don't believe it will for a few reasons. Number one is over 80% of mortgages in the current market have fixed rates, okay? And that's really, really important because it's difficult to default when you have a fixed mortgage rate, okay? Number two is there's 20% less demand, or I'm sorry, there's 20% less inventory because there's there's been an underdevelopment from home builders in the last 10 years. Our population has been increasing. Home builders have been building less because they got burned 10 years ago after the housing crisis. Number three is foreclosures are at a historical low. It's hard to have default. It's hard to have a housing market crash if there's no default and foreclosure and if there's a lack of inventory. So we got demand is high. You got population growth is booming. You got millennials forming families, making more money. Yet we have 20% less homes. We have historical low foreclosure and default. How can we have a crash if there's not people foreclosing? And this is the kicker. We are at the highest amount of equity that homeowners have ever seen in the history of homeownership. Over 50% equity. So the average homeowner, let's say, has a $400,000 home. They got about $100,000 to $200,000 of equity. So if, God forbid, someone loses their job, and people will, and it's unfortunate, that doesn't mean they have to foreclose. They could just sell their home, probably not pay the mortgage for a few months, and save up a couple bucks. And instead of the bank taking their home away, they'll just sell it, take their equity, and go rent. And then the other kind of a secret that's someone kind of like peeking out of the closet there is Wall Street. What do you think is going to happen? Is the average buyer going to be able to start buying all these foreclosures if and when they hit the market? No. Wall Street's going to come in and they're going to scoop up those homes in bulk, in cash, so the banks can just dump them all in big kind of trenches. And then that's hypothetical. But so even if we do see some foreclosure and some major turbulence during a recession, it's very unlikely the average home buyer is going to get to kind of wait and get a deal. I just don't see that happening.
Yeah, it's interesting. And I think, the last couple of years, like, as you mentioned, the market has just absolutely boomed, 2020, 2021, and then, obviously 2022 at the tail end, we started seeing things kind of fall off. However, inventory has been the huge issue. And you kind of touched on that with home builders, but in general, a lot of these people right now that, secured a mortgage in any time in the last 3, 5, 7 years, either they got a good rate out of the gate or they went and refied, right? So talk to us a little bit about inventory and why, even though we're seeing, contracts accepted going down, we're seeing closings going down month over month, but we're still seeing home prices stay pretty stable, at least here in the Chicago market. What are some of the reasons you think that may be?
I think it's because a few things. Number one is a healthy real estate market typically has about 6 months of inventory. That's just kind of like a stat that I think most people in real estate know. And right now, there's somewhere between 2 to 3 months of inventory. Fannie Mae and Freddie Mac, who govern lending, are estimating a home shortage of somewhere between 2 to 4 million homes. Shortage, right? Freddie Mac, and this is data, I'm not making this up. Freddie Mac said there's approximately 15 million mortgage-ready home buyers on the fence right now, waiting for affordability to come back down because home prices shot up. Interest rates shot up, so the cost of having a mortgage went up 40%. Our incomes across the nation didn't go up 40%. They actually stayed pretty level. They haven't dropped substantially. Unemployment, even though there's all these layoffs, unemployment's still relatively low. It's going to get worse. There's going to be more layoffs in 2023. But to answer your question, the population increase, the shortage of 2 to 4 million homes, only 3 months of inventory versus 6 months of inventory. And the main underlying factor is what we call the great seller stall. Right? Sellers are stalling right now because most of them have a fixed rate near 3%. Anyone that bought her or owned a home had refinanced in either 2020 or 2021, and they have a really low rate. So why would you sell a 3% rate to go take a 6 or a 7% rate and be worse off than you are? So you have all these sellers who probably would sell if the market was normalized. You have them holding onto their properties and their 3% rates like a warm, fuzzy blanket. And then you couple in the lack of inventory. I mean, there were supply chain issues because of the pandemic, because of costs of fuel, everything going on with China, things coming on boats. There was freaking, ships stuck in canals around the country. I mean, the last 2 years really rattled our supply chain. And now there's a backlash on that. There's a time delay that's now slowly, things are coming now and it's flowing, but you can't build a house in 6 weeks. It takes 8 months, sometimes a year to build a home because of seasonal elements and weather and things like that. So all these factors are gonna minimize home values dropping because for every great home that pops up, there's a bunch of people that want it. There's not like, there's not, you know what I mean? Like there's not an insatiable demand, but there's still a bunch of people that are ready to buy for the right home. And there's just not enough inventory because so many sellers are just hanging onto their property right now.
Yeah, no, that's a great point, and that's what I'm seeing. Being, like I said, boots on the ground here as a realtor, helping my buyers, is the properties that are nice. They're in a good location, their condition is good, and they're priced to sell. These are still going under contract very quickly, and they're going under contract, either right under what they're actually asking for it, or even sometimes even still over asking price. Not on all the properties, but on a lot of the good properties out there, that's what we're still seeing. So
Right.
I want to go into a little bit about kind of the paralyzing effect that I think maybe why the end of 2022 was kind of this cause of concern, because we started to see rates go from 3%. The Fed was determined to crash the housing market, Jerome Powell. So they raised the
Fed
prime
funds
rate.
rate.
Yeah, they raised that like 4% over the course of 6 months. And
Right.
I think what we're seeing is a lot of these buyers and sellers, they just were paralyzed by the unknown of what's going to happen and how this is going to play out, because that's not a lagging indicator, right? So when the rates jumped up, that was just the leading indicator, and we haven't yet really seen the back end come around on that. So going into 2023, I feel like now people are a little bit more normalized to the current real estate market. They're a little bit more normalized to interest rates. And at the very peak, we saw almost like 7.75% on the interest rate. And now we're sitting somewhere at 6.5%. So tell me a little bit more about, now that things are coming back down, at least in the last couple of months, they're settling in. I think you said around like 6.5% right now. And I feel like now people are like, okay, well, at least we have a little bit more of this like concrete data, so that we are not paralyzed by this anymore, and we can start to continue on with our life plans. And as you mentioned, a huge subset of the population are in these family formation stages. A lot of my friends that I have, they're not. And, I know a lot of people are struggling right now, but a lot of my friends are making more money than they ever had. And they're having babies, and they're moving from one place to another. So talk to us about what you're seeing currently with interest rates, mortgage applications in the new year, and kind of, where you see the next 4 months going.
Yeah. So a couple things. Number one is, remember, people are feeling a lot of fear and confusion right now because of what's going on, rightfully so, right? Everything's more expensive. Gas was so expensive. Groceries are expensive. Traveling became super expensive. So we went from like the best 2 years ever outside of the pandemic and all the health concerns, like financially. I mean, you can make money doing everything. People were making money in crypto, NFTs, drop shipping, any sales business was booming, and all of a sudden it's like gas went up. You couldn't buy a car. Plane tickets like quadrupled. Everything became more expensive. So you factor that into the fear in the headlines, it paralyzes people. And most people make decisions off emotion, not logic. So it's very difficult to remove the emotion if you don't have the logic and the data, right? That being said, historically, recessions are caused by high inflations and high Fed rates. So what happens is, as inflation goes up, the government raised rates, the cost of everything goes up. Remember, the Fed's not raising mortgage rates. They're raising the cost of money that impacts all type of loans and all type of consumer, financing. So what they're doing is they're trying to get inflation to come down. So mortgage rates tend to correlate to inflation. So every month or so, we get these different economic data points, CPI numbers, consumer confidence, inflation numbers. As inflation starts to come down, the Fed is not going to raise rates as aggressively. They're still going to raise rates maybe 1/4 or 0.5%, but they're not going to raise them 0.75% every time they meet. So it's counterintuitive. If the Fed raises rates 1/4% the next time they meet, that means inflation's actually coming down because they don't have to raise rates as aggressive. So people are going to be confused, but what's going to happen is, if inflation keeps coming down, we should start to see mortgage rates come down. And so a lot of experts that study mortgage economics and all the correlations predict inflation should be substantially lower by the summer or even Q3 of 2023, which means mortgage rates should follow suit. So the most aggressive predictions are mortgage rates. The most aggressively optimistic predictions are mortgage rates somewhere between 5 and 5.5%. I wouldn't be surprised if they sat in the mid to low 6% range, and then eventually sometime in the second half of next year, they drop into the mid to high 5% range. Now remember, this is a term that's super important: recency bias. The recency bias means we're used to what we recently saw, and it impacts our decisions. So when interest rates were 3% and they went to 5.5, 6, people are like, they were just 3%. Now they're 5.5. Like, like because their most recent memory was that. And then so it paused their behaviors. It froze them. Then they went to 7.5, and then like people just started having, like fainting, right? But when they go from 7.5 to 5.5, and our last memory is 7.5, 5.5 is going to look really good after a year of seeing rates in the 6 and the 7s. So my prediction is prices will kind of stabilize a little bit. Inflation and mortgage rates will come down towards the second half of next year, and consumer demand will erupt because people have been on the sidelines. Now, remember, rents are rising every year. They're going up 8 to 10% per year. Some people are locked into a 1 or 2 year lease. Maybe it didn't go up. But for most people, especially new leases and new construction apartments, rents are rising. So you're not really saving money by renting as far as like you're not like sheltered from rising costs. Everything's going up. So if rates come down and that recency bias says, whoa, 5 looks a lot better than 7, all these millennials on the sidelines rush the market. What's going to happen? It's going to be negotiating, pushing prices back up. Buyers are going to be losing leverage because now there's 10 offers instead of 2. And it's going to be a very similar story, I think, to what we saw in 2021. So my prediction is, or my recommendation is, if you're a buyer and you can afford the home that you like and you can comfortably make your mortgage payments, and it's a great place for you or you and your family or you and your significant other or you and your friends to live or invest, buy the home now, because time in the market is much better than timing the market. And if you wait too long, you might have to pay more in 3, 6, or 9 months when everybody and their mama comes out of the woodworks trying to buy again.
Yeah, it's like this yin yang effect, right? So right now you have higher rates, and we're going to get into this here in a second about some creative ways that we can go about actually, getting those a little bit lower. However, you also have more negotiation power, right? So
yes, you have
when
leverage.
There's less demand when there's less demand in the market, you have more leverage as a buyer. So right now, compared to 2022, 2020, 2021, and then about halfway through 2022, you weren't going in and making an offer anywhere under asking price. You are either at asking price or you're over asking price. Everything that I've been working with, with my buyer clients in the last 2-3 months, we've actually been negotiating, 2, 5, 10% off of asking prices, even though they have a higher interest rate, maybe sitting at, 6 3/4. They're now getting, let's call it on a $500,000 home, $50,000 or $25,000 off the asking price. So, what would your advice be for somebody that's like sitting on the sidelines? They want to get into the market. Maybe they don't have a massive down payment, but they want to get in, but they also want to make sure that they have an affordable monthly payment.
Yeah. So to answer your question specifically, I think your housing payment shouldn't exceed 28% of your gross monthly income. And what you do is you take your annual income, you divide it by 12 to get your monthly income. This is gross pre-tax. And you basically take 28% of that, and that's what you should really look at for your housing payment. So to use easy math, if you make $10,000 a month and you want to be budgeted and conservative and frugal, and remember, like, young millennials are going to be saving and investing for the next 30, 40 years, you shouldn't overspend on your home. So if you're making somewhere between $8,000 to $10,000 a month, you should have a housing payment under $3,000. And that's going to allow you to have a comfortable budget so you can continue to save and invest, because compound interest over the duration of the next 20, 30 years of our lives is much more critical to your building wealth than having a really high mortgage payment, not being able to save and invest for the next 5 to 7 years after you buy your first home. So again, I think you should definitely consider the economics of buying, right? In other words, like, yes, like, I don't want to overspend, and yes, I should look at a budget, but just because rates are higher and the media is telling you it's a bad time doesn't mean it's a bad time if you can afford it.
If you can afford it. Yeah. And that is the thing. I feel like a lot of people right now, on the flip side of this, the negative is a lot of people that need a home, maybe they can't afford the payment on the home that they actually want. Right. So I think that is somewhat of an issue right now. And you just pre-approved me, right? So I'm going to be out on the market, and, I was qualified for a higher amount, but I'm trying to be frugal. I want to be smart. So based on what I can qualify for, I want to be much less than that, just so that I can get in and be able to have the ability to be just a little bit more, what's the word I'm looking for? A little bit more nimble, so that I can go out and make sure I'm not making any bad financial decisions.
A great mortgage lender, I just want to make this clear, a great mortgage lender should help a buyer understand a conservative payment, an average payment, and an aggressive payment based on their income. And when you have that data and that decision I'm sorry, when you have that data and that information, it makes the decision-making process much more transparent, because then you're not thinking with fear, you're understanding the data and the numbers so you can make a confident decision when you do see the right home. And so you can be accurately qualified so that when you're with your realtor, you're looking at parameters, home buying parameters that you know are going to keep you in your budget. And then you can act confidently. You can negotiate with a little bit of leverage and take advantage of this market. Because remember, in the Midwest and the East Coast and a lot of places, there's also a seasonal element where the wintertime, Q4 and Q1, there's just less home buyers in the market. You couple in the higher interest rates, a little bit of fear, the looming recession, some layoffs. There's a lot of pent-up demand on the sideline. So when the masses are on the sideline, this is a great time to get a deal, get a credit, buy your rate down, and just have a little bit of, negotiating leverage.
Definitely. So for that buyer that's out there that is wanting to purchase and they have the down payment, however, they're just a little bit, I don't know if the word is frustrated, they're just a little bit, put off by a higher interest rate.
Yeah.
Talk to us a little bit about some ways that if you have a good real estate agent, you can leverage a seller credit to help offset or potentially lower that interest rate.
Yeah, absolutely. So one of the most common strategies has been using a seller credit to buy down your interest rate. There's a couple different ways you can buy down your interest rate. You can buy it down permanently for the duration of the loan. My preferred strategy is called a 2-1 buy down, where you have a 2-year buy down program. So your interest rate is 2% lower in the first year, 1% lower in the second year, and then it would go back to whatever the market was in year 3. But again, we believe rates will come down in the next 2 years. So 2 years of a lower rate should be sufficient to soften your payments. And then when interest rates come down in the next 12 to 24 months, we can help someone refinance, or their lender can help them refinance and get back into a market rate. So, a 10K price reduction, and remember, people think in price, but they live in payment. A 10K price reduction is about $60 a month in your payment. You're like, woohoo, I saved 10K. You didn't really save 10K in your pocket. You did on paper, but you don't really have 10,000 more in your pocket. But if you can take that 10K and instead of a price reduction, apply it to buy down the interest rate, your payment can be $400 to $600 lower per month. That's a big deal for people. And because remember, they live in the payment.
Yeah, guys. So from the real estate agent side of that, so like if we're making an offer on a property, right? And let's just say they're asking $500,000. Well, maybe now we offer them 550, or let's just say 510, and then we negotiate a 3% seller credit. So ultimately, as Justin just said, you're paying more for the property, but that extra $10,000 is a very small amount as it relates to your actual mortgage payment. But now you just got a $10,000 credit, which is still the same amount net to the seller. So they're actually willing to still take that deal because you're giving them 510, even though for you, you're now getting the advantage of having that, essentially that credit to apply in various different ways to either lower your rate or potentially just allow you to get into the home with less money out of pocket.
Yeah, it's all about equilibrium, right? Some people are just super focused on the numbers and getting a deal. Other people need to have a payment that's comfortable for them because expenses and payments went up, but our incomes for the most part have remained the same. So if you're on a salary and you were kind of dabbling in 2021 and 2022, and all of a sudden you're like, oh my gosh, everything got so much more expensive, but your income hasn't changed. You're a cop, you're a teacher, most people just have a fixed salary. And so these strategies are really applicable and appropriate for folks that have a fixed income and need to get their payments down. And that's why it takes a good lender, a good realtor, and some creativity to help you figure out the best way to put the puzzle together.
Yeah. Now more than ever, I feel like just having, full-time professionals that have a good team. So for example, having a real estate agent, having a lender, having an attorney that all work cohesively together and that can actually talk to you about the facts that are happening in the market and not all the headlines. I think that's so important right now. So a couple more questions about interest rates and then we'll get off of here today because I know you got a lot going on. I appreciate your time. But what about ARMs, adjustable rate mortgages? Are you seeing more of these? Are more people taking advantage? Like, what would be your recommendations around adjustable rates?
Great question. Historically, in a non-volatile market like we're in, historically ARMs, so let's say a 7-year ARM means your interest rate is only locked in for 7 years. It can change, but after the 7th year, it can adjust. Historically, those have been anywhere from 1/4 to 0.5% lower than a fixed rate. So in a high rate environment, if you want some payment relief, and you're not going to be in the home longer than 7 or 10 years, you take an ARM, your payments are lower. But over the last 6 months, the lending world, they want people in stable loans. So the ARM rates haven't been as attractive. They're almost very similar to where fixed rates are. So unfortunately, there's not as much payment relief on the ARMs anymore because they're not as low as they typically are. There's no spread between fixed rates. So right now, the best option is whatever the best option is, right? And it's typically just going to be a standard 30-year fix or a 15-year fix. And again, you just want to make sure you can afford the payment until you can refinance.
Awesome, guys. Well, Justin, I want to get you out of here. So right now I have Justin's Instagram at the bottom of the screen at Justin Lapine. So Justin has been putting out a ton of great content on his Instagram, on his TikTok, with this type of information, just educational content to allow home buyers and sellers to really understand and to take advantage of the current state of the real estate market. So do you have anything to say on that?
No, I appreciate that, man.
Something.
Yeah, I think
okay.
Right now this is a great time to learn and get educated before you make a big decision. And don't let the headlines and the media, and that fear cloud thinking through data, getting aligned with good people who are going to look out for your best interests.
Yeah, guys. So if you want to start that education and that kind of that information gathering stage, go check out some of his videos. You can go check out mine as well. All that will be in the description down below. Also, if you're thinking about buying a home or moving to Chicago in 2023, feel free to text me. My number is there at the bottom of the screen. We would love to help you out. We have buyers every single day reaching out to us talking about moving to Chicago. So we are helping people. I just had somebody from London reach out to me that's moving to Chicago later this year. I just had somebody from Texas. So if we can be of value to you in any way, we would absolutely be honored. So Justin, that's all we have for today, man. Really appreciate you, all your wisdom. It's been an absolute pleasure, working with you and helping all of our clients out. So without further ado, let's close it up.
Sounds good, buddy. Thank you so much, man. Great to share this information.
All right, guys, take care. We'll talk to you soon. If this has been valuable, please do us a favor, like, comment, and subscribe. We'll catch you on the next video. Peace.